Compound interest is often described as a mathematical concept, but in the context of retirement savings, it is far more than that. It is a force that quietly rewards patience, consistency, and humility, while punishing delay, interruption, and overconfidence. Many investors say they understand compounding, yet behave in ways that consistently undermine it. This gap between understanding and application is why compound interest is celebrated in theory, but underutilized in practice, especially when it matters most, preparing for a future where earned income can no longer be relied upon. At its simplest, compound interest means earning returns, not only on your original contributions, but also on the returns those contributions have already generated. Money begins to work on top of money, creating a self-reinforcing loop. Early on, this effect feels almost invisible. Contributions seem to matter more than growth. Progress appears slow sometimes, disappointingly so. This is the phase where most people lose patience or underestimate the importance of staying invested. Yet this quiet period is not a failure of compounding. It is the incubation stage. The real power of compound interest reveals itself over long horizons, which is precisely why it is so well suited to retirement savings. Retirement is not a short-term goal. It is a multi-decade objective with a fixed endpoint and irreversible consequences if underfunded. Compounding thrives under these conditions because time is its primary input. The longer capital remains invested and uninterrupted, the more dominant compounding becomes relative to contributions. Eventually, growth overtakes saving effort, and the portfolio begins to expand, largely on its own momentum. One of the most important but least intuitive truths about compound interest is that time matters more than rate. Investors often obsess over finding higher returns, believing that a better performing strategy will solve everything. In reality, starting earlier at a moderate return often beats starting later at a higher return. Years lost at the beginning cannot be recovered by taking more risk later, without dramatically increasing the chance of permanent damage. Compound interest is front-loaded in opportunity and back-loaded in reward, which is why early participation matters so much. Consistency is the second pillar. Compounding is not compatible with stop-and-start behavior. Contributions that are skipped portfolios, that are abandoned during downturns, or strategies that are constantly reset interrupt the compounding process. Every interruption forces the engine to restart. Retirement savers who succeed are rarely those who made brilliant tactical decisions. They are those who kept contributing through boredom, fear, and distraction. Compound interest rewards persistence far more reliably than intelligence. Another critical element is reinvestment. For compounding to function, returns must remain in the system. Dividends, interest, and capital gains that are reinvested accelerate growth dramatically over time. When returns are consumed too early, compounding weakens. This is why retirement accounts are structured to encourage reinvestment and discourage premature withdrawals. The rules are not arbitrary. They exist to protect compounding from human impatience. Volatility often scares people away from compounding, yet volatility is not the enemy of long-term growth. What matters is not short-term fluctuation, but long-term participation. Compounding does not require smooth returns. It requires survival. Investors who exit during downturns and re-enter later often miss the most powerful periods of recovery, permanently reducing the compounding effect. Staying invested through volatility is uncomfortable, but it is the price paid for exponential growth. Taxes also play a subtle but significant role. Compounding works best when friction is minimized. Tax-deferred or tax-advantaged retirement accounts allow returns to compound without annual erosion. Over decades, this difference can be enormous. Paying taxes early and often reduces the base on which compounding operates. Retirement savings strategies that respect tax efficiency are not about clever loopholes. They are about preserving the raw material compounding needs to function. Perhaps the most overlooked benefit of compound interest in retirement savings is psychological. Compounding shifts responsibility from constant decision-making to system design. Once contributions are automated and investments are aligned with long-term goals, the investor's main job becomes not interfering. This reduces stress decision fatigue and the temptation to chase performance. Compound interest favors those who can leave well enough alone. The tragedy is that compound interest is perfectly fair and perfectly unforgiving. It does not care about intentions, intelligence, or effort. It only responds to time consistency and discipline. Those who start early, stay invested, and reinvest patiently are rewarded disproportionately. Those who delay, interrupt, or constantly reset pay a quiet but severe price later in life, when time can no longer be added to the equation. As retirement approaches, the benefits of compounding become obvious, but by then, its most powerful years are already behind you. Understanding this early changes behavior. It reframes saving from a sacrifice into a strategy and investing from a game into a system. The real question is not whether compound interest works, but whether your behavior allows it to work on your behalf. Because knowing that compounding is powerful does not automatically mean you are positioned to benefit from it. And understanding how to structure retirement savings to fully harness compound interest. Avoid the common mistakes that weaken it and respect the realities of time and risk is exactly where we need to go next, by examining when compound interest is intentionally designed into a retirement strategy rather than left to chance. Because compounding does not reward awareness, it rewards structure. The first practical step is automation. Contributions that rely on willpower eventually fail. Automatic recurring contributions turn saving into a default behavior rather than a monthly decision. This removes emotion from the process and ensures that compounding has uninterrupted fuel. Investors who automate early do not save more because they are disciplined. They become disciplined because the system saves for them. Asset allocation is the second lever. Compounding needs growth to work, especially in the early and middle stages of retirement saving. Portfolios that are too conservative too early sacrifice the very returns that compounding depends on. This does not mean reckless risk-taking, but it does mean accepting volatility as a necessary ingredient. Over time, as retirement approaches, the role of compounding gradually shifts from growth to preservation, and allocation should evolve accordingly. Compounding thrives when risk is aligned with time horizon, not when it is avoided altogether. Avoiding premature withdrawals is non-negotiable. Nothing damages compound interest more than taking money out early. Withdrawals do not merely reduce the balance, they remove future growth on that balance forever. This is why retirement accounts impose penalties and restrictions. They are not punishments, they are guardrails. Treating retirement savings as untouchable until its intended purpose protects compounding from short-term needs and impulses that can often be addressed elsewhere. Another critical behavior is resisting the urge to constantly optimize. Chasing the best-performing fund, switching strategies frequently, or reacting to market noise resets compounding again and again. Retirement compounding is not about being right often. It is about being wrong slowly and staying invested. A good enough strategy executed consistently usually outperforms a brilliant strategy executed inconsistently. Compounding magnifies behavior more than skill. Reinvestment discipline continues into later stages. Even when balances grow large and returns become meaningful, reinvesting dividends and interest during accumulation years accelerates growth dramatically. The temptation to enjoy returns too early weakens the exponential curve. Consumption has its place, but timing matters. Compounding is strongest when consumption is delayed until the system is mature enough to support it. Tax awareness also compounds. Using tax-advantaged accounts, understanding contribution limits, and placing income-generating assets in appropriate vehicles preserves the base on which returns grow. Over decades, reducing friction is often more impactful than increasing return assumptions. Compound interest is sensitive to leakage. Every unnecessary dollar lost to taxes or fees shrinks future growth disproportionately. Perhaps the most important protection of compounding is emotional management. Market downturns will occur. They will feel personal and threatening, especially as balances grow. Selling during these periods does not just lock in losses, it removes future recovery from the compounding process. Staying invested through downturns is not optimism, it is mathematics. Recoveries do not benefit those who are absent. In the end, the benefit of compound interest in retirement savings is not that it makes you rich effortlessly, but that it makes discipline powerful. Small, ordinary actions repeated over long periods produce extraordinary outcomes. Compounding turns patience into leverage and time into an ally. But it only works for those who respect its rules. Start early, stay consistent, reinvest relentlessly, and interfere as little as possible. If this discussion reshaped how you think about retirement, consider subscribing to stay with these long-form conversations focused on long-term behavior rather than short-term tactics, and leave a comment sharing what you think is the biggest threat to your own compounding process, because identifying that threat early is often the most valuable return you can earn.